There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, traders of the world, to the Saturday Software Strategy Market Chat and general ramblings of yours truly. My name is Steve Vetterl. Today is 6/4/2022. It is the beginning of the last month of the second quarter. Let's see if we can say that like 10 times. Do follow me on Telegram. Invitations are forthcoming and all of that stuff. As always, do note I actually posted probably one of the better pieces on top 5 characteristics. I know a lot of traders are always looking for quick hits, and quite frankly, most of this stuff is just absolutely awash in risk management. So also posted a nice piece. This one's actually hanging above my desk. If many of you do not know who Paul Tudor Jones is, he's one of the most respected hedge fund managers on the planet. He is one of the most successful, also runs the Robin Hood Foundation. If you ever heard of them, they are one of the few charities that does truly quality work. So the most important rule of trading is to play great defense, not great offense. Every day I assume every position I have is wrong. I know where my stops are, and I do that so I can define my maximum drawdown, right? At the end of the day, the most important thing is how good you are at risk control. So those of you that have been following me for some time, this may seem somewhat redundant, but I know we have a fair amount of new subscribers. You can follow me at FXES Trader on Twitter. Try to post, do a lot of retweets, all kinds of good stuff there. In addition to that, if you go to the website of our company, First Down Financial Inc. here, you can see a lot of the risk management. This is actually a risk management presentation I did for Auvoria, in addition to everything else on here, which is mostly just trading and having lots of fun with different casts. I do another cast on Tuesdays. I try to do these right just after both 10 a.m. on Saturday and 1 p.m. Eastern time on Tuesday. So without further ado here, let's take a look at the Forex calendar. Starting off, always want to go to the next week, putting the dates in. I like to put a little filter action in, get everything out of here. Red folders, goodbye. I should say red folders and non-colored folders, all we care about. So big holiday this Monday and Sunday. I think this is the Europeans' version of Memorial Day. Am I right about that? I could be wrong. For those overseas that I may have offended with my incorrect knowledge of your holidays, I apologize. Call me the dope of the day. But important to note that next Friday is unemployment for Canada. Okay. Press conferences. Notice, though, interesting, I don't see anything on the calendar next week for the Fed, right? There's been 20 different schools of thought that I've gone through on the Fed, and Markets, at least as far as equities, are in an up direction, although you wouldn't know it after Friday. But we have had many, many days of a bounce this week with a lot of heightened volatility. What's been going on, at least from a macro perspective, in stock land for those that use the MT4 platform to trade varieties of movements in different types of hybrid stock indexes. The Many of the hedge fund, and for that matter, really anybody in portfolio management land that runs a fund, has really been caught flat-footed. Many of them have been caught short. So there's this juxtapositioning battle going on between buyers and sellers, obviously creating a lot of volatility. But many of the biggest funds have been caught too short. Hence the term I often use, which is called a face ripper. And it is a violent up move in a violent down move trend, or a longer term trend down. The exact same opposite can happen, but it is more volatile and considerably more pressure oriented. When there is a downtrend and there's too many people caught on the boat, the algos love to terrorize those groups by ripping markets up and clearing the queue of all stops on the way up. So I've talked about that a lot, but it just seems strange to me that many students, many followers, a lot of people that DM me just don't have the they just don't look at it. It's like somebody saying, "Oh, I forgot there was a news story," and they got completely blown out on their stop, right? So let me jump back to the screen. Of note, since I don't really have anything else to say about, actually next Friday, core CPIs is going to be important. You can see where the forecasts have been, where the actual has been. We've either matched it. There was a little surprise in April here, but in May we were back to prices going way up. So keep an eye on that as well. At the end of the day, if you hadn't heard any of my previous chats on previous Saturdays, the core is that one of the Fed's main mandates, other than full employment and a stable interest rate environment, is to quell inflation, to put it to bed, to put it to rest, to get rid of it, to push it down under the mat. Whatever their particular end result is they're not accomplishing that right now, but they have raised by 75 basis points to try and do that, and that's why we've seen big hits in both equities and bonds globally since the beginning of the year. Where we go from here is a tough guess. I'm betting the Fed has to raise more, but I'm betting they take a little break because they probably want to see what's going on in the markets. So let's just move to a discussion of markets. And for those I may have caught in, I think it was it was the Saturday before, I forget. We were supposed to be on vacation in Key Largo this weekend, but if you've been paying attention to the weather, it's like massive storms. We had to move the vacation to next weekend, so I will not be broadcasting next Saturday. I'll post that on Telegram, but a lot of people may not check Telegram so if you guys could spread the word, I'll actually drop it in all of the chat rooms as well, so everybody's clearly aware. If I do have the opportunity, it isn't pouring rain again next weekend down there, I can certainly broadcast, but for now, I'm on vacation. All right, so we are looking at a chart of the S&P. Each candle represents a single day. We can look at all kinds of different time frames, but I choose to start my analysis, at least with this index, with the daily chart. You can see where we bounced down. We had a huge rejection reversal day. That usually will, in most charts that look like this, limit the downside for now. And that downside has varying degrees of sort of pressure, but every time you see a candle like this that was with some decent volume, as you can see, it usually will hold us at some point on any market for some period of time. I don't know how long. It's always different, but you can see the rejection reverse right here, and it's allowed us to bounce back up. Right? And this is really the ceiling, if you will, of where we had a face rip, and then the markets came back down against it. And this was actually a huge day up on Thursday. I mean, this has probably flipped out a lot of shorts that had size on the market short in their portfolio. So, and then obviously the big down on Friday. So, where do we go from here? I mean, my guess is we needed to spend some time balancing in this area, auctioning between highs and lows before we move out of this range. But I would bet that the ultimate target is right here. Why is that? Because a lot of people think the market has a lot more down to go, and they would be surprised, generally the masses, if we went to this level in the S&P. And this is an area of what I call max pain. But they tell, if we were ever to make it through that area at some point, sooner than later, obviously you want to see that happen sooner, because especially if you're bullish, you want the markets to go up. It really is going to put a lot of portfolios on this planet out of position that were betting on significant downside because the Federal Reserve's moves. The biggest surprise to the markets, at least in equity land, of the U.S. indexes, let's focus on first, would be going back up to new highs. Yeah, that can't happen. No, it won't happen. There's too many people talking about downside. So the risk in that is always take where the vast majority of prognosticators and these market analysts and people I try not to be, because collectively we're almost always wrong, right? Try to take us and put us in a category or a scattergram, if you've ever seen it, and choose something else. Now, why do I say that? Because markets generally, and there's a bazillion people that'll argue this point, but markets generally are efficient. The more liquid, the more traded it is. You're looking at one of the most traded indexes on the planet, along with the futures market that's attached to this. Contract's called the ES, the mini S&P's future contract. These are exceptionally liquid markets that, for the most part, act very well. Even though there's more volatility, they generally act quite well, and they can be very volatile. So the biggest surprise, I think, to most traders would be us going back up to new highs. So that's what I'm actually betting that we do. Now, what happens when we get back to new highs? I don't know. You have those saying, that would be max pain. And then once everybody's loaded the boat long, they'll pull the rug short on it, and then we'll start going down a whole bunch more. It's happened a lot over the last couple of decades. And many can't see it, and that's okay. So not really like pointing to one direction or the other, just trying to use what's been going on in a risk control parameter so that you understand. Always pay attention to what most people are not talking about, right? So what are they not talking about? So there's actually a pretty good piece if you Google it. I forget where it is, but I came across it on Twitter of these guys that have had like a ton of success with what's called anti-goals, meaning they set a goal and they use an example of somebody going down a river. And this is actually a fantastic discussion for risk control because it just fits right in. But let's say you're going down the river in a canoe, and your goal is, even though the river is going to be rapids in some cases, and then maybe you're going down the river in some sort of whitewater raft or whatever you want to call the scenario. Your goal is to get to the end of the river without capsizing the raft and dying, right? And have some fun, hopefully, along the way. But, it is fraught with all kinds of problems. So the anti-goals in this trip are the rocks and stuff you'd hit along the way. And what do you need to do to avoid that? Okay. So I consider sort of the anti-goals, the things that could disrupt your trip. And instead of focusing solely, as many do, on that goal at the end, focus on the stuff along the way, much, much more that could disrupt your plan. Okay. So I'll just leave it at that without, sort of dragging this out and turning it into a Grant Cardone session. Even though I do love the guy, let's focus on the markets. That's S&P. Nasdaq's in a little more uglier position, but it's got to break up into this whole 1230, 12,400 area for it really to see max pain, which essentially is just under 13,000. US dollar is next. So let's show the whole screen. All right, so pretty epic climb in this. If you're not haven't been tuning in since hell, whole last year actually, right? You could see the climb in the U.S. dollar over the whole period of time. You're looking at a chart that starts from Q3 of last year to now. So over the course of approximately 3/4 of a year, we have, just a major ascent broke out, came into actually a fairly nice cup of handle. You can see right here, had another breakout, actually had another cup with handle, sloppier one, broke out again, and went all the way to just under 105 at the top. This took almost everything else down with it, any major. And we were basically saying this is going to be a blow off top. I would probably look to see it backfill or essentially trade back and fill it. Markets can't just go up and up and up and up. I guess they certainly can. As I've often said, markets can remain irrational a lot longer than you can remain liquid. But in this particular case, we got up closer to 105, and I said we'd have a significant pullback. Typically, you want to pull back to the whole range. Now we've had a pullback, formed some support and resistance points via our squeeze indicator here. And so far it's held and begin the backfilling process as I had anticipated. So I would imagine we'll stay in this unless some sort of large exogenistic event hits the marketplace or some central bank decides to do something different. All right, so let's take a look at the euro. It's going to be the opposite of everything I just said. The absolute floor, which is the uncorrelated area of 105 on the dollar, is this 1.0350-ish area. That's the floor for now. But the squeeze zone floor is up here right at 1.0450-ish area, something like that. Now we're even in a tighter squeeze. I should say tighter sideways trade. If you wanted to see some longer term analysis, I think it was what, 2 Saturdays ago, if I'm not mistaken. GBP. Let's make sure we're on the daily here. Whoops. What did I do? Actually, you know what? Let's take a look at the. Something looks off here. Let me just reset the zone. Look at the daily chart. Let's do a reset. Trading views kind of acting up. In any case, 121, basically 122, 1.22 area here. $1.22 is the floor. This has been in a pronounced downtrend for some period of time, which was capped up here at 142. So as a U.S. resident, if you want to buy anything from the British give a much better rate now to purchase expensive foreign luxury goods. I wonder if Rover's got a European delivery program, though it's more affordable right now. In any case, that's kind of what I see going on there. Canadian still in a very long sideways trade. These are all daily charts. It's been a big surprise here, the absolute erosion of the yen's value in relation to the dollar. Here's the Canadian erosion, which looks very similar as you can jump between these two. For those that trade US dollar, I would say we're probably looking to break out. And I would say this is going to be predicated upon the dollar, at least hanging around the end of the range that it's at on the high side. We're more likely to break out here. Same could be said for, just jump back to, I'm looking at the wrong currency. I'm all discombobulated this morning. Maybe my body thinks I should be in vacation mode, but it was canceled. Let's see, Euro GBP, I get asked for this sometimes. It's just been a one long sideways trade. This, by the way, is a good example if you're looking at all the market profile links on the left. I haven't really, this is pretty solid data. It's getting more data. I did a lot of complaining about this in the beginning. I think somebody at TradingView heard me, and I started focusing on, and it has pretty good trading data, but they overlap it with other data coming in. Up here, we've got just not a lot of volume, right? So typically markets, and I can't really say this for two that trade fairly lockstep. I'm more interested not necessarily in the major currency pair here, but the chart patterns that develop with these, so you guys can continue to see the repetition of some of these patterns that can help you put risk control in your trading. Got a lot of missing volume up here, right? No surprise, haven't spent any time up there. So if you're listening to what I said earlier and you're starting to absorb it and you're saying, well, geez, maybe there's, that could be the max pain area for this pair. Yes, it could. GBP CAD. Now we're back down. Let's take a look at a big chart on this. This thing's actually acted pretty well. I mean, if you just look at spending some time in the zones and then it broke the zones, and most of the break of the zones came on higher volume, so no surprise, it acted quite well. I mean, but we're back down to just the pound. Just it's almost like the pound isn't worth a crap these days, and the Canadian dollar is. And it is really, I haven't spent enough time because we are deep in the throes of our startup. And we've had a couple of very large deals potentially come to us. Will take even more of my time. Hopefully, they can squeeze enough out of me so that I can continue to be the Auvoria guy. But this looks ready to do a quick reverse. So my hope would be that Neo is acting accordingly for its trade recommendations. I know it's not trading off a daily chart, I get it, but I only try and just look at the charts from the macro perspective on this and just, here's what I think it should be doing, right? In the grand scheme of things, I didn't mean crap because it's going to do what it wants, not what I want it to do. But at least you guys won't be as surprised if you listen to enough of these or look at these charts yourself and understand how this type of analysis can play out for how your algo should act. So floor here's 1.5720-ish area, 5,700 area, right? Other side of the balance area on the high side is this one spot, 61.38-ish. Looks like this got extended lower on Friday, if I'm not mistaken in what I remember. What else do we want to look at? AUD CAD stuck in a tight sideways trade. GBP NZD, we haven't looked at this in a while. Surprisingly, it hasn't done all that much. It's still stuck in a lot of these currencies just want for other things to play. Spot gold, I haven't shown this to you guys in a while. Usually, I think that, actually, let me take a look at this on a weekly. Some noise here. So in the end, we still never made it back up to touch that 2000 area. And in this example of a longer term weekly chart perspective, you can see this metal has not acted like many thought it would. Many thought it would be right up here by now, just because of the unrest and inflation and all that other stuff. And this chart just continues to signal to us that there are other time frame players of big institutional nature. We call them OTFers just because we lump them in one category, that are up there defending these high prices, or they're selling chunks. It could be a sovereign fund, it could be a bunch of hedge funds, it could be a whole mess of mutual funds, it could be whatever fund, right? It doesn't necessarily matter. The key is to lump those guys into a group called OTF. So you can actually Google that term, other time frame players, right? So the OTF group, they don't want prices higher right now. It's that simple. So as the wand of volume is waved across this metal, prices are staying sideways. Not the best for any kind of short-term trading, in my opinion. Although I got to believe Max Payne in this particular case truly is up around this 2100 area. It is total Max Payne up here. Markets like to go to where Max Payne is because most people don't believe it's going to that area. Oil, I hate even looking at this. I really do. Yeah, mostly because I got two gas guzzling cars and I'm about to buy a third one. It's even more of a gas guzzler and a boat. So I choose not to look at it because then I just make myself feel bad. So let's get down to the coinage. Take a quick look at NVIDIA. I'll tell you, NVIDIA really just, it is quite enticing, this 160 area. Now, this is not a broadcast about individual equities, but I know many of you out there are buyers. This is one of the best run companies on this planet, and they have a product that just continues to be in stellar demand. And it really is just a tooling factory problem with many of these chip guys. That is the reason they're not making even more oodles of money. But you want to see a chart start to, find that floor on a daily perspective, and notice where that floor is. It's right around that 160. So is it a fair value price? I don't know. Certainly the over leveraged whatevers, OTFers on this planet were wicked heavy in NVIDIA, right? So they've been forced to liquidate, and even the best companies that have the anomaly going on as they do, and the demand for NVIDIA's, chips, cards, video, everything with these guys just continues to be off the charts. But doesn't mean the stock price can't come down to reflect fair value of what the marketplace sees. So in that particular respect, I don't, this is why you always let the charts play out, let things continue to trade sideways, and then possibly form a cup with handlers, some associated chart for breakout higher. Let's take a look at the coin. So this is Bitcoin. I'm looking at this again on weeklies. I'm just choosing to look at the weeklies because they cut out a lot of noise. But you can see we have solid support, as I'd been talking about for months and months and months. That we were going to get back down to this support. We are here, and there has been very, very weak attempts to break higher. Now, if you're asking, well, where's max pain on this? I'm going to let you guess. So if you're some laser-eyed crazy on social media, like a lot of these nutcases you see, and notice a lot of them have completely disappeared, by the way. All kinds of stories of some of these smart pies taking complete loss of risk management and the understanding core principle of it, and putting most of their net worth in this stuff. It's just getting absolutely flambéed. So don't be that person, right? At some point, this will be back. I think it's going to take a lot more pain before it comes back. I would like to see this a lot lower. I would be a buyer in this range right in here. This would be my first toe step. May never get there. Could be living in fairy dust dreams on that, right? But it's happened before. And a 90% correction in the ashes of something like this, which probably will go up again. I'd rather wait for the ashes to start sifting through them. Maybe you could find a decent piece of coal in the ashes and it could turn into a big blazing fire of rallies again. But for now, I'm not interested. Let's see. Oh yeah, and for those, just for what it's worth, that said Coinbase is worth $250 a share, and yeah, no surprise. Many of these coin companies are going to go. They're going to go bust because trading's going to dry up, right? All these washouts are over and over and over again in history. So recognize the mania. Don't get caught up in it. If you rode these things up into that mania and you did not sell, hopefully you've learned your lesson that you want to take some off the table while the mania is a mania, because that is proper risk control. And with that, I wish everybody an excellent week of trading. Hopefully you're not getting rained on in Florida because it is absolutely pouring today. But I wish everyone a healthy and a happy trading career filled with lots of seven-figure accounts. My name is Steve Vetterl. Today is the 4th of June. May the trades be with you.
There is a substantial risk of loss associated with trading Forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.